Welcome, everyone. Another great episode. Uncorrelated investment classes. What are they? The biggest pensions do that. They don't just buy mutual funds. They have the uncorrelated assets. They often get better returns than the average investor. We're going to dig into all of that today. So you definitely want to stick around.
Yeah, we like to call it that uncorrelated, but basically it's an alternative. That's exactly what we're talking about today. Alternative investments, ones that you normally don't find in the public space, but you find them in the private space. That's a big differential that we want to deal with. And to start off, let's take a look at what the asset composition looks like for the CPP. Now, this is the source, is the 2022 CPP annual resource or annual report, should I say. And if you take a look at it, you've got it broken down basically into 6 sectors here: the infrastructure, real estate, credit, public equities, private equities, and fixed income. But a lot of that stuff is dealing with that private sector. As you can see, there's private equities, there's public equities, infrastructure and real estate. They also tend to be private. And credit, we can also get a lot of that credit sector that also tends to be private. So as you can see, CPP has a lot of what would be considered alternative investments in them, or private investments, as opposed to things that are basically in the public entity. Don't they, Clint?
They certainly do. They certainly do. So again, the idea here is uncorrelated with general public stock markets, public bond markets. Those are the ones most folks will invest in. You own a mutual fund, you own an ETF. Chances are it's in one of the big public markets, either stocks or bonds. And what you can see here, and this is an example of CPP, but Harvard Endowment, Yale Endowment, all the big pensions, all the big endowment funds, they have a lot of private investments in the mix as well. We're calling that the alternative asset class. And in this case, it's a really big chunk because infrastructure, real estate, credit, private equities, a whole bunch of that is likely in the private sector. It wasn't always that way, though, was it, Kevin? No. This has been a transition we've seen really over the last 15 years.
Yeah, I mean, basically beforehand, it used to be very much a public entity up until the Great Recession back in 2008, 2009. You would find that mostly all of this was public. You'd have maybe 95% of the entire portfolio was dealt with in public entities. But when you had rates go down to all-time lows, you had a market that wasn't getting you the resources you needed or the income that you needed, all of a sudden you had all these endowment and pension funds look to the private space or the alternative space to try and get better returns. Also to even out their risk and things along those lines. It's just another arrow in their quiver for the investments that they could put together. So it was very particular to get it in at that time. And now, as you've seen, they've got a ton of their investments now outside of that public space.
Yeah, and in a year like 2022, like last year, where you had the public and the private markets take a bit of a hit, those uncorrelated assets were very, very helpful because they give you something a little more stable. Let's go through a couple of examples. We can start with private debt. We're lumping 2 big categories here: private debt and private equity. So the credit, the fixed income, we're lumping all of that into an umbrella we're calling private debt. Why don't you walk us through that, Kevin?
Yeah, and the private debt, a lot of this would have to deal with basically sort of mortgages and how that's dealt with. I mean, normally you can get your mortgage at the bank, but if you don't qualify at a bank, say you're self-employed or new to the country, then you may have to go to a mortgage place to deal with it. And a lot of those mortgage companies, they are in the private debt space. So what happens then? They put out mortgages for a certain period of time. They're collecting at a certain rate of return, and you can buy into these private companies. And that way you're going to have access to whatever they're going to return there. So you could get rates that are higher than what you can get for GICs or fixed income that you can trade in the public space. And that's where a lot of that private debt scenario comes in, is in that mortgage space, so that you can try and get better returns and smooth out, because as we know, just because real estate goes down, it's not all pieces of real estate that go down. And in a private sector, that's going to give you a little bit better stability going forward.
Yeah, and often the private mortgages, they're quite short term. They don't want to compete with the big banks and the 25-year mortgage. They often do 1-year deals. And because of that, very liquid, very accessible in most cases. And you tend to get higher returns, like you said, than you would from a traditional GIC, but you're not getting all the volatility that you might get from the stock market. So that's kind of the nutshell of the private debt category. Lots of nuance in there, but that's the overlay of the big category. Private equity, Kevin, some big building blocks here in Canada. We see a lot of infrastructure, a lot of real estate falls under this piece, but there's more to it than that. But let's start with some of those big blocks. What about private equity on the real estate side?
Yeah, private equity on the real estate side is basically, as opposed to dealing with the mortgage side of things, they actually own the apartment blocks on this side, and they own some of the private equity real estate. So, I mean, a lot of it is in that apartment block space because, again, if you can fill 98 or 99% of the apartment block, doesn't matter what the market's doing as a whole on retail or what it's doing on possibly in the office space. So you can get a better aspect for getting growth out of that investment. Because as we've seen, traditionally, real estate has constantly gone up over the long period of time, even if there's been some short fluctuations. So that's one thing to look at for sure, is the real estate side of things. But there's more to private equity than that, isn't there?
Yeah, we'll have to touch on the other pieces. And a reminder, when it's private, it means it's not in the public markets. This isn't like a public stock REIT that gets all the volatility. The private equity REITs are valued on a different metric. Usually the metric's related to the apartment block or whatever it is they own. The infrastructure piece of this puzzle, infrastructure, the big bulky things. Usually investors would have trouble accessing this part on their own because these are the cell towers. This is your data centers. This is your toll highways, the big bulky pieces that are essential to an underlying economy. Hard for an investor, an average investor, to access this. So usually you only get it through a private equity investment or something of that nature. And again, the idea here is stability. It's a little more consistency. And you see a lot of these too, the real estate and the infrastructure in the big pension funds, in those big endowments. In fact, CPP, they had to strip it out because they had so much. They had to create their own category just for real estate and just for infrastructure because they had lots in the private equity space in those two categories. But there's more to it than that, right? Private equity is a large category. What else could you see in that private equity space, Kevin?
Yeah, I mean, and we're doing this on a fairly high level scenario right now. So we're just touching on things. If you have more questions that you do want to find on private debt or private equity, please go to chatwithclintonandkevin.com. We're more than happy to clarify a little bit more on each space that we can deal with in that format. But you're right. In the private equity sector, there is more than just that. I mean, you could be involved in a variety of different investments that are out there that you can't. I mean, airports are another one that they try to get pieces of. So things that traditionally you don't really have access to, or there's not really a company that's designated towards that in the public space, you may find in the private equity space and be able to get access to it from there.
Yeah, a couple of examples. Farmland, music royalties would be that category. Sometimes just private companies specifically can be in that category as well. So there's lots. It's a very large category, and there's lots of different ways to invest. And that kind of leads to a couple of tips here. One is risk. They're not all the same. Like alternative investments is such a large category. Some are very, very low risk, can give you lots of stability, some very consistent returns. Some are very high risk and very speculative, and everything in between, right? It runs the gamut. So you really have to make sure you know what it is you're investing in and the associated risks. Another factor here when you're in the private space, Kevin, liquidity.
Yeah, basically being the private space. I mean, it's not in a constant state like a mutual fund, which is constantly in production of being able to produce more and more shares to put out there. There's only a limited number of amount of money that these guys need. So they invest most of that. Trying to get that money out means that your liquidity may not be the same accessibility. Whereas you usually get, sort of daily activity in the markets. Here it could be, once a month, once a quarter, sometimes once a year, things along those lines before you get it out. It is private. They do want to put that money to use. So your liquidity may not be the same as you get out of a public investment.
And you have to obviously be cognizant of that, right? So if you're a long-term investor, hey, I don't need the money. Well, it might not be as pertinent. If you're retired and you're taking money out every month, well, then this might be very, very pertinent. You want to make sure the liquidity matches your overall goals, right? So it's not just the underlying investment. The risk factor is important. The liquidity is important. And then the idea here, diversification. The old adage, don't put all your eggs in one basket. That certainly applies to the alternatives. And why do people add alternatives to their portfolio to begin with, Kevin? It is that diversification. The idea, it can help smooth out the returns, right? In bad years, well, they're not influenced by the public stock market, so maybe they do better in those years and gives you a more consistent return. In fact, that's exactly what we saw in 2022. And history, if gives us any kind of guide, they've done that in the past as well. So they can be more steady performers, which can help mitigate some of the risk and give you a more consistent profile for your overall portfolio. So certainly something to keep in mind. It's what the large pension companies do. As Kevin mentioned, this is a very broad category. We're barely touching the tip of the iceberg. So please get a hold of us. If you have more questions, chatwithclintonandkevin.com. It's part of our website. Fill it in. We'd love to hear from you. And this is a common question we get. How do you stabilize the portfolio? How can you mitigate risk? Alternative assets are one way to do that. Another question we commonly get is whether or not you should pay down debt or you should invest. And we have a whole video on that, Kevin. You know what? It's probably floating above Kevin right now. So you can click on that one and we'll see you there. Take care, everybody.
See you then. Thanks.